Welcome to the deep dive. Today, we're tackling one of those really tricky decisions in finance, maybe one of the most emotionally charged. When do you sell an asset that's doing great?
Right. The classic wisdom is just let your winners run, isn't it?
Exactly. But what if a truly legendary trader flipped that completely on its head?
You must be talking about Dan Zanger.
We're diving into his sell into strength idea. It's pretty contrarian. This is the guy who kind of famously now turned about, what, $11,000 into over $18 million?
In just 18 months, yeah. During the dot-com craziness. And an incredible unofficial record.
Incredible. So our mission today, let's unpack his system. How can this, well, aggressive but also risk-averse strategy help you lock in profits and maybe, just maybe, avoid some regret? Okay, let's get into it.
That's so good.
So to really get Zanger's sell into strength thing, we actually need to start with how he dies. It's all connected, you see.
Absolutely. The entry dictates a lot.
He's laser focused on what he calls frisky stocks, high volatility, explosive potential. And he looks for really specific chart patterns, things like the cup and handle.
That classic consolidation shape.
All flat bases, where a stock trades sideways for a bit after moving up. Or flags, pennants, those kinds of continuation patterns.
Right. And the entry trigger itself is super precise.
Yeah, he only buys on a breakout above that pattern's trend line. And crucially, it has to happen with a big surge in volume.
Like at least 50% above the recent average volume, right? That confirms the move has power behind it.
Exactly. And he won't chase it. It never pays more than maybe 5% above that breakout point. The whole idea is to catch that initial burst of momentum.
And it's that aggressive entry that immediately sets up the first line of defense. A really, really tight stop loss. Almost intolerant, you could say.
How tight are we talking?
Well, if a stock breaks out but then immediately stalls or reverses, he's out, sometimes within minutes. He talked about maybe $1 or $2 stop below the breakout price for higher price stocks, or just a hard 5-8% stop loss. No messing around.
Okay.
And here's something interesting. He might even sell if the stock just stops going up, if it goes to sleep, as he puts it.
Because most people would just hold on, right?
Right. But his view is stocks are only good when they're moving up. So if the momentum dies, he's out. It ensures only the absolute strongest stocks stay in the portfolio.
Okay, so aggressive entry, super strict stops. But here's where it gets really interesting, I think. The core of selling into strength. Zanger's 15-20% partial profit rule.
Yes, this is where he really bucks the trend.
He literally says sell 20 to 30% of your position as the stock moves up 15 to 20% from its breakout point. Some people even say he'd sell half after just a 20% gain.
Let's make that concrete. Say you buy 100 shares at $50. That's $5,000 invested.
Okay.
Stock goes up 20%, so it hits $60. Zanger says sell, say, 25 shares. That's 25 times $60, $1,500 back in your pocket.
Right. And the crucial part there is that $1,500 could be a huge chunk, maybe even all, of your initial $5,000 risk capital, depending on how much you sell.
Exactly. The rest of the shares, the ones you still hold, they effectively become house money.
Psychologically, that's huge, isn't it? Suddenly, the fear of losing your own capital is mostly gone. You're freer to let the rest run for potentially much bigger gains.
It absolutely is. And this ties straight into behavioral finance, Why is this strategy so powerful, but also so hard for people to actually do?
Yeah, talk about that.
Well, market tops are usually built on pure emotion, right? Euphoria, greed, massive FOMO, fear of missing out. Everyone piles in at the end.
We've all seen it.
But the biggest barrier preventing people from selling is regret aversion. That deep-seated fear of selling too soon and watching the stock double again after you're out.
Oh, yeah. Kicking yourself because you left money on the table.
Precisely. And that leads to the classic disposition effect. Investors tend to sell their winners too early to lock in some profit, but hold on to their losers too long, hoping they'll come back, cutting the flowers, watering the weeds.
So Zanger's rule, it's like a preemptive strike against your own emotions.
Exactly. It's mechanical. You take that first chunk of profit off the table based on the rule, not on how you feel. It forces discipline and lets you manage the rest logically. You've banked a win.
Okay, so you've taken that initial partial profit. Your risk is way down. You're holding house money. How do you know when to sell the rest? When is the big move finally over?
Right, that's the next piece. Zanger emphasizes spotting signs of trend exhaustion when the party's about to end.
What kind of signs are we looking for?
Think about those really wild, unsustainable moves, a parabolic curve where the price just goes vertical, like GameStop or AMC did. That acceleration often happens right at the end.
Okay, like a rocket running out of fuel.
Sort of. Another big one is a blow-off top. That's a sharp vertical price surge on absolutely massive volume, often followed by an immediate sharp reversal the next day or even intraday.
Volume being key again.
Always. Volume is the heartbeat of the market, he says. A huge climactic volume spike late in a long uptrend. That's often the smart money selling out to the eager late-coming public.
Got it. Any other signals?
Yeah, watch out for an exhaustion gap. That's when a stock gaps up significantly on huge volume, but it happens late in an established trend. It looks super bullish, but it often acts like a trap.
A trap. How so?
Because those gaps often get filled quickly, the price reverses and falls back down to close the gap. It sucks in the last buyers right before the trend rolls over. These are all signs the upward momentum is fading fast.
So putting it all together, Zanger's sell into strength isn't really about cutting winners short, is it? It's more sophisticated than that.
It's not at all.
Yeah.
It's a disciplined system for managing risk and, importantly, managing your own psychology. It's designed to make sure those paper profits you worked hard for actually turn into real spendable cash in your account.
Protecting capital, locking in gains, staying logical. Makes sense.
It really does.
Yeah.
And it leads to a broader thought, doesn't it? If doing something counterintuitive like selling into strength works so well in trading,
Yeah.
well, it makes you wonder what other areas of your life beyond finance might hold hidden advantages if you dared to act against the conventional wisdom, against your initial gut feeling. Where else might a contrarian approach unlock something significant for you? Something to think about.